In the next couple of videos, we're going to talk about how do we find the value of a company. In particular, we want to ultimately narrow this down to think about stock prices. If you remember, in previous videos, we talked about the primary focus, the objective of making financial decisions is to increase wealth. How do we measure the wealth of a company? We measure its wealth through its stock price. So in this videos, we're going to talk about this process. How do we ultimately find the value of a stock? It comes from the value of the operations of the company. So we're going to review some basic terminology about stocks, and then we'll get into the quantitative part of how we can ultimately calculate today's value and therefore also predict future value. So, what do we need to know about stocks, right? We know that it represents ownership. Ownership implies control. So, who actually controls the company? Now, stockholders essentially elect directors. Directors hire management. So, management is really who controls the company. So, since managers are agents of shareholders, their goal should be to maximize stock price. Owners, why do people buy stock? We don't talk about this enough. Why do people actually want to buy stock? They buy stock because they want to increase their wealth. How do they do that? They do that through the cash flows that they receive. They get dividends and they also get price changes, hopefully positive price changes. If managers cannot provide dividends and or increases in prices, shareholders won't buy the stock. In fact, they will sell the stock. It will be difficult for the company to expand and grow because they won't have access to capital markets. What is classified stock? Certain companies have these different categories of stock, if you will. Typically, they'll be named something like Class A, Class B, etc. But what's the difference? Why are they different classes? Well, first of all, what's different about them? They could be different voting rights. They could be different dividend rights. So these particular stocks can have different characteristics of ownership. So typically, new shares in an IPO, sometimes they'll have voting restrictions, but they might have full dividend rights or vice versa. The reason we have these different classes has more to do with control than it does anything else. So let's think about two reasons why this might happen. If a company is owned by a family, and this family wants to expand, they want to issue stock, but they don't want to give up control. What they might do is create a different class of stock. Class A stock belongs to the family. It has voting rights and dividend rights, of course. And Class B stock has dividend rights but does not have voting rights. So the family is going to gather funds, but they're not going to give up any control of the company. That's just one type of classified stock. Well, there's another kind of stock it's actually pretty rare, but sometimes corporations, it's not a complete spin-off, but the dividends that are provided to a particular shareholder are tied to a division rather than the company as a whole. This way, essentially, we can separate and value the divisions of the company. Tracking stock might not have any voting rights. It just has to do with this dividend. And again, there's very few different companies that have tracking stock. So how are we going to address the valuing of common stock. We're going to start talking about the entire firm. Then we're going to look at dividends and how we can use those to talk about value. And then we'll end up talking about some multipliers at the end. That was a mistake. That should not have been there. So, onward and upward. Cash flow valuation model. We've talked about free cash flow several times. It's the cash that's available to distribute to all of the company's investors. It's generated from the company's operations. The weighted average cost of capital. We haven't discussed this in great detail yet, but essentially it's the rate of return required by all of the company's investors. So it's the cost of financing. So how do we utilize these concepts? To find the value of operations, the first thing we do is determine the free cash flow for a certain period of time by periods, moving on to the future. And we find the present value of all those future cash flows using the weighted average cost of capital for the company. How this works in a more simplified formula says the value of the firm is the value of equity plus the value of debt. If I can figure the value of the firm, value from operations, we can ultimately determine what is the value of the stock of the company. If we expand this model a little bit, we have the value of operations is the free cash flows estimated to infinity divided by the weighted average cost of capital. Now, conceptually, this is correct, but you can't find the present value of an infinite stream. But if we could simplify this algebraically, and we can, it provides a simpler version of this formula. So this formula is algebraically equivalent to this formula. If you take the free cash flow today and multiply it by 1 plus, the growth rate of free cash flow in the future, divide that by the weighted average cost of capital minus that growth rate, that will give us a calculation or a value of operations. Again, this formula and the previous formula are algebraically equivalent if we have constant growth, that's what we're assuming here, and we have an infinite time frame. If those two things aren't present, then this formula doesn't work. So again, this just represents the present value of all free cash flows from time one through infinity when we discount at the weighted average cost of capital. Just one little caveat though, we have to make sure that the growth rate moving forward has to be less than the weighted average cost of capital, or the denominator becomes negative and we can't have a negative value. So let's look at a company. The free cash flow is $24 million. Weighted average cost of capital is 11%. We think that the free cash flow is going to grow at 5% to infinity. We have some short-term investments of the company of $100 million, $200 million in debt, $50 million in preferred, and we have a total of $10 million in shares of stock, 10 million shares of stock. So how do we find the value? Solving for value here, 24 million times 1 plus the growth rate divided by weighted average cost capital minus the growth rate. This company has a value of $420 million. So how can we put that in perspective here? How can we find the value of the stock? So the value of equity is the value of operations, right? That's that calculation, plus some short-term investments. Why do we include short-term investments? Because when you buy a company, you receive those assets. So that is essentially is cash. So this company has a total value of $520 million. Subtract out the debt and the preferred stock. So the value of equity is $270 million. Divided by the 10 million shares, this stock would have a value of $27 per share. Now, there is a worksheet that we can utilize this to calculate the free cash flow of a stock. And again, just inputting the data, we find out that the value of the company is that 420 million. We had the free cash flow at the very beginning was 24 million. Here's the short-term investment, debt, preferred stock. We ultimately end up with that $27 of value per share. Now, as we move forward in these videos, we're going to complicate this model. We're going to add to it. We're going to change and some of the variations of the variables, but we want to explore again, how does the company, how do you increase value? These are the formulas we're going to look at. So again, look forward to talking to you soon. Bye-bye.